Hello, everyone, and welcome to our 15 to 20-minute recap summary of the popular webinar topic, Incorporating Equity Compensation into Your Overall Financial Plan. My name is Beata Dragovic, and I am the founder of Freedom Trail Financial, which is an independent wealth management firm in Boston, Massachusetts. We do personalized financial planning, wealth management, and investment management counsel, and we do have a specific emphasis on working with professionals in the life science field. For today's agenda, based on my experience working with folks in this field, your major focus is most of the time is on equity compensation. Equity compensation, stock grants, stock options are a major part of your compensation package. And trends are changing, compensation types are changing, and as well as tax considerations, what we need to look at are ever evolving. So what we will talk about in this summary, we will touch base on the trends. We'll definitely touch base on the new tax reform bill and how that affects your equity compensation. We will also talk about the different taxation of stock options and restricted stock. We will touch base on concentrated equity holdings and really mention a few strategies that you can use when that happens, as well as we will take a quick look at how this all fits into your overall financial plan. Trends in your industries, what is it that drives compensation trends in the life science industry? That is really the question. And it has been, and it's going to be for definitely the next foreseeable future, is the demand for talent, and competition for key employees is continuous. The industry is very volatile. The high-risk nature of the industry here in the U.S. as overseas definitely affects compensation trends. IPOs for 2018 is going to be strong, expected to be strong. There are definitely trends that started many years ago, and that is mergers and acquisitions among big pharma and small biotech that's going to continuously affect your compensation package. And really, due to the volatility of the markets, more and more C-level executives are unwilling to put large percentage of their compensation into traditional option awards. Therefore, companies are granting less and less of these awards for all employees and use more restricted stock. Really, let's look at further. So really, as it comes to your compensation trend, it's all about diversification. Really, performance-based long-term incentive plans became the most popular. Performance shares has more than doubled from 28% to 60% in the last 10 years, according to Willis Towers Watson Data Services. And at the same time, use of stock options has declined from 66% to close to 40%. So definitely those are the major trends. Close to 70% of companies are granting usually at least two different vehicles, meaning stock options and at the same time stock grants. So they use at least a mix of two or more vehicles as it comes to equity compensation. I do like to point out that equity compensation is not just stock grants and stock option, even though that is a huge part of it, but you do want to pay attention to matching contributions in your 401k, which is in the life science industries very high. In comparison, there are non-qualified deferred compensation plans, you receive health insurance plans, and so on. So really, when you make a decision to potentially go to a new company, or you really compare offers during negotiations, you definitely want to take a look at that, and you really want to look at the entire package as it comes to your compensation. So how do we look at this? this is a very colorful slide, the only one that I was able to make colorful, obviously due to the topic, but this is where we should all start, right? All of us here, everyone who's listening, we all have, as human beings, we all have priorities, and they are definitely not to be too sarcastic, but our priorities are definitely not taxation of stock options, right? Everything that we are talking about, we should really at the same time just take a step back and think into for a moment why this is all matters. There is really no one answer that fits everyone, and that goes for your financial decision making as well, right? You need to understand your own personal financial, your personal situation, your personal values, and really you want your decisions to be in alignment with your own financial goals and these personal value system. Once you know really where you stand, what's important to you personally, and what goals with that financial goals are most important to you personally, you will be able to make very good decisions as it comes to your equity compensation as well, which sometimes can be challenging. A successful well-building strategy for equity compensation will always begin with a discussion of the role that stock grants will play in your financial life, exactly as I mentioned before. Along, you want to identify your core values, beliefs, and activities. I believe in that strongly. Um, you want to understand what role of your stock grants can play in building really your wealth towards any of those life goals. And how you start that, you need to know what kind of investor you are. Are you a wealth accumulator? Are you a corporate insider? Potentially, there are certain rules you have to abide with. And also, are you financially independent? That again will make a big difference in the decisions that you are making. We will majorly assume that we are, majority of us are wealth accumulators. And if you are a wealth accumulator, your planning for stock grants usually will involve qualifying and quantifying goals related to financial milestones, along with managing risk. Of course, what can be your goals? They can be planning for retirement, funding college education, or really buying a second home. Um, if that you are a wealth accumulator, your primary role of stock option is to really to provide a greater share of the funding for these goals, right? Most of the time, your income, your net worth, your health benefits are all tied to the success of your company. So you definitely want to promote diversification, and you will definitely majorly benefit from planning strategies that really prioritize risk, generate cash flow as well. And I'm not saying taxation and tax minimization always is important, but if you are a wealth accumulator, it shouldn't be the primary and only primary role. If you are a corporate insider or an executive C-level professional, you face additional planning considerations because your actions are obviously highly visible and are watched by regulators, shareholders, and employees as well. You are subject, when you are making trades, you are subject to blackouts periods. In these cases, you are prohibited from trading. So really what you want to make sure that you put in place is what we call Rule 10b5-1 trading plan. This trading plan will allow you to make trades for your company stock at a preset periods with preset price. And most of the time you have to set up these plans before you know insider information. And this will not 100% protect you, but definitely is gives you a certain amount of protection. Then, if you are financially independent, obviously you do not face critical planning concerns with stock grants, but definitely you still want to make sure that you can maximize your wealth and preserve what you receive. So stock grants, without a doubt, remain a key component of many employees' total compensation and major wealth building opportunity. The most two four common forms are incentive stock options and non-qualified stock options, as well as restricted stock and restricted stock units, and we'll touch base on that. What is the difference between that? So a stock option, what is a stock option? A stock option gives you the right to purchase a certain number of shares of common stock of the company at a certain exercise price for a defined period of time, which is most of the time 10 years, unless you leave the company, which obviously in that case exercise period is reduced. Usually there is a vesting schedule for when you can exercise stock options. And obviously in the event of termination, there are termination without cause or your voluntary termination, you will have most of the time, much lesser of the time, approximately three months to exercise your vested options. There are two different type of stock options: incentive stock options, which have tax advantages, and non-qualified stock options. Sorry about that, and we'll talk about that in the upcoming slides. So restricted stock units, restricted stocks are the right to receive shares of company common stock upon vesting, really at no cost to you. Again, RSUs generally vest on a yearly basis from the grant date. The major difference is that restricted stock units have no voting rights until the shares are issued to you upon vesting. Restricted stocks do have voting rights. Unvested restricted stocks units obviously again automatically forfeited upon termination of employment, so that's definitely something to look at. And most importantly, on the vesting date, you will have compensation income subject to ordinary income tax rates based on the fair market value of the common stock that vests on that day. So restricted stocks are a more definite way of receiving stock grants from your company, as it is you are definitely receiving. If you work for a public company and it's not a private company, you are obviously definitely receiving the shares, and you will have a equity in the company that day. At the same time, there's a little bit less of a tax planning strategy that you can do. You know most of the time in advance what will be added to your taxable income, but there's not as many strategies, really tremendous planning that you can go do as it comes to taxation. Let's look at all of these, what we just talked about, and really understand it one by one. So it is crucially important to understand the taxation of stock options and restricted stock for no other reason because these are the major grants that you will receive, and it can significantly impact your taxes. I always recommend, and I would like to mention it right here as well, you do need to consult a tax professional as well as financial advisor before you would make any changes. So incentive stock options, as you can see it in the middle, at grant there is no tax event. Then you have a holding period, which is a 1 year from grant date and 2 years from grant date and 1 year from exercise date. At exercise, you are not paying regular taxes, but it is AMT preference item. So the bargain element, which is the difference between the grant price and the exercise price, that is what we call the bargain element, and that is subject to AMT taxation. Then you would need to hold, in order for the incentive stock to stay qualified and have the preferable tax treatment, you need to hold it from 1 year from exercise date and 2 years from grant date. So again, the holding period there becomes a little bit different. And then above and beyond that, you will have capital gain. You pay capital gain taxes on the excess of above basis, which is in this case is the exercise price, and that's actually I do want to mention that is the grant price. So we don't want to mix that up. The non-qualified stock option, there is no tax event at grant. Holding period, you don't need any. The ordinary income you are paying on the difference between the grant price and the exercise price. And if you hold it, if you do decide to hold it 1 year for after you exercise the non-qualified stock options, you will pay long-term capital gain taxes. If you sell it before 1 year, it can be ordinary income because it's shorter than a 1 year holding period. As it comes to restricted stock, I want to mention no tax event again at grant. There is no exercise here because you are receiving the stock, but there is vesting. So upon vesting, you do pay taxes, or as I mentioned to you before, it is compensation income. At that point, you have a decision to make if you would like to hold the stock or you will sell it. And again, whether long-term capital gain taxes you are paying or potentially ordinary income, that depends on how long you hold the stock. I also want to mention here one more important fact, that a restricted stock has one very interesting tax benefit. Restricted stock allows for what we call the 83B election. That allows you to pay taxes on the grant price versus the exercise price. So you have 60 days to make a decision when you receive a grant, when you receive a restricted stock, not an RSU. And you will have 60 days to make this decision. If you believe you are bullish on the stock, you believe the stock will go up, you have 60 days to make the decision, and you can pay taxes on the grant price. So as many of you know, the Tax Cuts and Jobs Act, new tax reform, just passed in December of 2017. So let's take a look at that. But how did that all affect your stock compensation? Obviously, changes in the individual tax rates happened, and they actually got reduced a little bit. So the new rates are anywhere between 10% and 37%. But most importantly, what really happened is there was a change in the calculation of the alternative minimum tax. And the income spread, as we know, as we talked about in previous slides, the income spread at incentive stock options can trigger the AMT, right? If you don't pay regular taxes, but it can trigger the AMT. While the AMT and really how that applies to these ISOs has not been repealed, what happened is that exemption amounts changed. So the 2018 AMT income exemption amount for single filers rose to 70,000, just over 70,000, and for joint filers over 109,000. That's some married joint filers. And most importantly, the income where this AMT income exemption starts to phase out, it got substantially adjusted upward. Starts at $500,000 for individuals and at $1 million for married couples. So definitely, what I would say that with fewer employees at risk of triggering AMT by exercising incentive stock options and holding the shares, I would say that companies may start to actually grant more ISOs and more frequently, because it will definitely give potential tax advantages for more and more participants, employees. There was no change in the capital gain tax rates. There was a new type of qualified stock grant for privately held companies that happened. This is what we call now the 83I elections, and it's the Empowering Employees Through Stock Ownership Act. And it lets employees in a privately held company elect to defer taxes at option exercise or RSU vesting for up to 5 years, as long as the company's equity boards meet certain conditions. So this is what we call the 83I election, and this is something new that will probably have effect on a lot of employees that work for privately companies who are receiving RSUs or stock options. And there was actually a repeal of the performance-based exception to the Section 162M limit on deductible compensation. This means that basically publicly traded companies will no longer be able to deduct annual performance-based compensation for C-level executives. Again, what we can see is that this will not give, companies might give more diverse equity compensation and stock grants based on this new provision. So really, what can be better for you? So if you have a choice, and most of the time when you can have a decision really, or a choice to negotiate which one you are receiving, is most of the time when you start and negotiating an offer. And because I see it less and less that companies actually give you the choice, which is that if you can get restricted stock versus stock options. I would say definitely, as with the restricted stock, upon vesting, you are definitely receiving the stock, assuming it's a public company, even in a private company, but let's assume we are talking about public companies. That's where it matters really with stock options as well. For stock options, you want to be very bullish on the stock. In that case, you understand that you can take more value out from a stock option. With a restricted stock, obviously, if you are neutral or bearish on the stock, you will still receive equity in the company stock. And I would say as well that you definitely need to know how far you are from retirement. If you are far away from retirement, or you definitely have more time to wait out stock options and to make sure, especially if your options are not in the money necessarily. If you are closer to retirement, you definitely need more cash flow. Your tolerance for risk is lower. Then in those cases, you probably want to rather choose restricted stock, more of restricted stock. So you need to understand what kind of investor you are. You need to understand where you are as it comes to your financial picture, current financial situation, and that will help you make more informed decisions. So let's touch base a little bit about concentrated stock, because what happens is that definitely with significant appreciation of employer-issued stock, it will always lead to concentrated stock positions. A concentrated stock position occurs when a significant portion of your net worth is invested in a single stock. So experts actually do not agree on exactly what constitutes a concentrated equity position. Some believe 10% or more, some believe even less. Definitely when you have 5, 10% or more of your net worth in a single stock, I would recommend that you start monitoring the stock. Obviously, when you do have concentrated stock position, suddenly you will have definitely multiple concerns, from estate planning issues to diversification, asset protection. So there's a lot more planning that you need to start focusing on, looking at, depending on again where you stand with your current financial life. I want to, for a purpose of one slide, I do want to mention that what kind of strategies you can do as it comes to concentrated stock. Obviously, I always recommend you can diversify, you can borrow against it, you can actually simply sell. So that's actually a strategy as well, to simply just sell a stock and diversify. You have to remember, especially if you are a wealth accumulator, you want to make sure that you feel comfortable selling some shares. You don't need to sell all of it. You need to weigh tax impact. But especially if you need to send a child to college, or you have immediate needs for some type of financial goal, you need to understand you need to sell. You can also exchange shares. There are some exchange traded funds where you can give up a certain amount of your stock, and that depending on the exchange traded fund, they might take in a certain amount of your shares. That's something to look at. Definitely donating your shares is possible as well if you are charitable, and hedging your positions with options. These are all definitely consult an advisor for more details about it, what makes sense most in your situation, but these are all opportunities as it comes to strategizing around how to make the most out of your equity compensation. And how does this all fit into your financial life, right? That's the major question. What I always like to end with is a life balance sheet. You need to understand where you stand. What are your assets right now, right? This is not a net worth statement. So your real estate property, your equity compensation, stock options, restricted stock, all part of your assets. And most importantly, your net employment capital is one of your largest assets at this moment, right? That allows you to save for your future goals. Your liabilities and equities will include not just your mortgage, but it will include, if you have kids, sending them to college, if that's the goal, your retirement, your vacation home. I believe you need to understand, you always need to understand how much money you need to fund those goals, to fund all of your financial goals that are more short-term, intermediate. Then you also want to look at your long-term goals that are important because you have to remember you can be close to retirement and realize that you don't have enough what you saved, right? So you need to fund first those goals, and after that, if you have discretionary wealth, that's again going to be a different way how you are looking at your stock options or equity compensation, and you have different ways of strategizing when you get to that point. Um, I highly recommend monitoring this on an annual basis. And obviously, you always, as in your industry, personalized medicine, right? Financial planning should be personalized as well. So make sure that one situation, one strategy will not fit all of you, right? So you always want to make sure, again, I want to reiterate that start with the discussion of the role that the stock grants will play in your financial life, identify your core values, and then the decisions will be easy. If you have any questions, thank you so much for your patience. If you have any questions, please feel free to call me, email me anytime. My email is bdragovics at freedomtrailfinancial.com, and my phone number is 617-247-1112. Thank you so much for listening. Have a great day.